Usually, when we think about buying a house, there is this deeply ingrained expectation of predictability. You know, you look for a quiet neighborhood, you check the school district, you verify the property lines, you sign the mortgage papers, and you just expect the environment around that asset to stay relatively calm, static, and, well, fundamentally unchanged for the next 30 years.
Right, because the entire premise of that kind of investment is stability. You are purchasing a known quantity in a known ecosystem.
Oh.
I mean, the value might appreciate slowly, but the fundamental physics of the neighborhood remain identical day after day.
Exactly. So imagine buying that house, settling in, and like a week after you unpack your boxes, you find out that 271 high-speed bullet trains are suddenly scheduled to park right in your backyard. The quiet neighborhood is just gone.
Yeah.
But there is a massive twist to this scenario. The city approaches you and says they are actually going to pay you a guaranteed premium interest rate to build all the tracks, the stations, and the switching yards for those trains right on your property.
Which completely shatters the original investment thesis. You no longer own a quiet residential property. You suddenly own the most critical logistical choke point in the entire region, and you possess a state-backed monopoly to profit from the traffic.
Yeah. That structural transformation from a quiet, predictable asset into the absolute epicenter of a massive, high-velocity infrastructure boom is exactly the reality we're stepping into today.
So welcome to our deep dive into Sempra. We are pointing our lens squarely at their Q1 2026 earnings call, trading under the ticker symbol SRE.
It's a fascinating one for sure.
It really is. And for you, the listener, we are taking the entire stack of corporate filings, the Wall Street analyst questions, the engineering reports, and the underlying macroeconomic data, and we are translating it into a talk tickers style breakdown. So that means data forward, opinionated, actionable, and in plain language. We're going to look at the pure facts, strip away the corporate jargon, and figure out what this actually means for anyone holding or considering this stock. And the context of this particular quarter really cannot be overstated. Sempra's Q1 call isn't just a utility update. It is functioning as a massive flashing indicator of broader macroeconomic trends. We are witnessing the real-time collision of traditional heavy metal energy infrastructure and the completely unprecedented exploding physical demands of global artificial intelligence.
Yeah, this is literally where the digital cloud actually hits the dirt.
Exactly.
Okay, let's unpack this by establishing the financial baseline. You have to know the score before you can analyze the game. For the first quarter of 2026, Sempra reported GAAP earnings of $1.037 billion. That translates to 1.58 per share. Looking back at Q1 of 2025, they were sitting at $906 million or 1.39 per share. So right out of the gate, we are seeing a substantial jump on the raw, unadjusted numbers.
Right, but as an investor, looking purely at GAAP numbers for a utility can sometimes be misleading.
Because of the infrastructure depreciation.
Depreciation, yes, but also massive commodity price swings. Wall Street inherently prefers to look under the hood at the adjusted numbers to strip out that exact quarterly noise. So on an adjusted basis, Q1 2026 came in at $991 million, which is 1.51 per share. That comfortably beats Q1 2025's adjusted earnings of $942 million, or 1.44 per share.
I want to pause on those two numbers because it is highly counterintuitive for a lot of people. The GAAP earnings, the official accounting standard numbers, were actually higher than the adjusted earnings this quarter. Usually companies use adjusted metrics to, hide bad news and make their numbers look better. Why would Sempra's adjusted earnings be lower than their raw accounting earnings?
Well, it comes down to the mechanics of commodity markets and how a massive energy company operates. So Sempra deals with physical natural gas and electricity, and they use complex financial derivatives to hedge against wild price swings.
Okay.
If the market value of those derivatives spikes on the last day of the quarter, standard accounting rules GAAP force the company to record that spike as a massive profit, even if they haven't actually sold the underlying gas yet.
Oh, wow. So it's just paper money at that point.
Exactly. It's called mark-to-market accounting. So by using the adjusted numbers, management is stripping out those unrealized paper gains to show you the actual cash-generating performance of the underlying business.
That makes perfect sense. It removes the illusion of a sudden windfall. And even with those paper gains stripped out, We are still looking at nearly $1 billion of adjusted fundamental earnings in a single 3-month period, which is a massive psychological milestone.
Absolutely.
And following up on that performance, management reaffirmed their guidance. They are holding steady on their full year 2026 adjusted earnings per share guidance range of 4.80 to 5.30. Looking further out into the decade, they reaffirmed their 2027 guidance of 5.0 to 5.70 per share.
Reaffirming guidance in the utility sector is basically the ultimate signal of operational health. I mean, investors allocate capital to these specific stocks for visibility and predictability.
Right, they want the safety.
Yeah. So when management affirms that multi-year guidance, they are telling the institutional market that their internal cost models, their supply chain projections, and their regulatory assumptions are holding up perfectly against the friction of reality.
And the physical reality of this business involves a staggering amount of cash going out the door to build heavy infrastructure. Sempra announced they deployed $3 billion of investment capital just in this first quarter alone. That puts them flawlessly on track for their massive $13 billion annual target, which is almost entirely focused on transmission and distribution, or T&D.
That's right.
But I have to stop and think about the sheer logistics of that. How does a company physically deploy $3 billion in 90 days? We were talking about $33 million being spent every single day.
The sheer physical scale of deploying capital in the utility sector is it's really difficult to conceptualize until you look at the individual components. They are not buying software licenses.
Sure, definitely not.
They're purchasing massive, custom-engineered step-up transformers that weigh hundreds of tons and take 2 years to manufacture. They are securing hundreds of miles of physical land rights-of-way across private property. They're pouring thousands of cubic yards of concrete for substation foundations, and they're deploying armies of highly specialized unionized line workers to string high-voltage 765 kilovolt transmission cables across entire mountain ranges and deserts.
It is heavy, slow, and incredibly capital-intensive engineering.
Exactly. It's the physical world at its most demanding.
I am trying to wrap my head around the return profile here, though. It is great that they hit nearly $1 billion in adjusted earnings, but we are talking about a regulated utility. If I invest in a technology company, their earnings grow because they invent a new product, and billions of consumers organically decide to buy it. In the utility sector, aren't these numbers heavily dependent on bureaucratic regulatory decisions rather than organic growth? I mean, they are deploying $3 billion, but they only make money if a government commission allows them to. It feels like a giant game of political math.
Well, viewing utility earnings through a regulatory lens is really the only way to accurately value the stock. You are highlighting the fundamental difference between a free market enterprise and a regulated monopoly. A tech company takes on the risk of consumer adoption. A utility takes on the risk of regulatory friction.
Right.
However, Sempra has reaffirmed a long-term EPS growth rate of 7% to 9%. That is one of the highest, most durable growth rates in the entire North American utility sector.
Which is huge.
It is. What's fascinating here is that metrics signals that the $3 billion they deployed in Q1 is not just a sunk cost sitting in a trench somewhere. It is actively earning a premium return because of the highly specific, highly advantageous regulatory environment they have successfully cultivated, particularly in the state of Texas.
Okay, let's dig into the regional engines driving this performance, because you don't generate $1 billion in quarterly earnings by accident. For Sempra, the two primary engines are Texas and California. Starting with Sempra Texas, specifically the Encore business. This is their massive transmission and distribution network that serves millions of Texans.
Encore is currently functioning as the absolute crown jewel of Sempra's portfolio. If you look at the detailed earnings variances, Sempra Texas saw an increase of $25 million in earnings for the quarter.
And what drove that?
The root cause of that variance is exactly the dynamic we just outlined. Higher invested capital combined with relentless customer growth. They are building out the physical grid, and the population of Texas is expanding rapidly enough to connect to it and pay for it.
The major victory lap on this earnings call was centered entirely around their base rate review. Encore officially received approval from the Public Utility Commission of Texas, the PUCT, for the settlement of their base rate review. We promised to strip out the Wall Street jargon, so let's break down the actual Texas rate math, because this is the specific formula that dictates how Sempra's investors get paid. The new authorized equity layer for Encore is set at 43.5%. Their return on equity, the famous ROE, is locked in at 9.75%. Finally, their cost of debt is set at 4.94%.
Right, and to understand the value of this stock, we need to translate how those three percentages interact in the real world. A utility company does not make its profit by buying electricity at a low price and selling it to you at a high price.
Which is a common misconception.
It's a huge misconception. The electricity itself is just a pass-through cost. They make their profit by building the infrastructure, the poles, the wires, the substations. So let's say Encore needs to build a new $100 million transmission substation.
Okay, $100 million.
The equity layer dictates how they fund it. At 43.5%, it means Encore uses $43.5 million of its own shareholder capital.
Got it.
The remaining $56.5 million is funded through borrowed money or debt.
So they put up a portion of their own money and they borrow the rest. Where does the profit actually come in?
The profit lives in the return on equity. The government of Texas guarantees that Encore is allowed to earn a 9.75% profit, specifically on that $43.5 million of their own money they invested in the substation.
Oh, wow.
Yeah. Meanwhile, the cost of debt metric assumes they are paying a 4.94% interest rate on the borrowed money. So the wider the mathematical gap between the 9.75% return they are guaranteed to earn and the 4.94% interest they have to pay on the debt, the stronger the financial health of the business.
Locking in a 9.75% ROE in a regulated, low-risk environment is just an incredibly powerful compounding engine for investors.
Absolutely.
And the timeline of this specific PUCT order is fascinating. The final order was received in April of this year, but the regulatory decision essentially allows them to travel back in time. They are authorized to implement the new billing rates covering the period between January 1st and June 1st of 2026. Management noted they will apply a surcharge to customers to capture that difference, which means the positive cash flow impact of this rate review is going to hit the balance sheet hardest right now in the second quarter.
And that base rate review secures the foundation, but it is really only half of the Texas regulatory story. The true catalyst for Sempra's cash flow velocity is a mechanism called the UTM filing.
Right, the Update of Transmission Management filing. Encore submitted its inaugural UTM filing last month, and the scale of it is staggering. They are actively incorporating $4.4 billion of transmission and distribution assets that were placed into physical service since January 1st, 2025, into their active customer rates.
The UTM is arguably the most valuable regulatory mechanism Sempra has ever secured. To appreciate why, you have to understand the historical vulnerability of the utility sector, which is a concept called regulatory lag.
Regulatory lag, what exactly is that?
So historically, a utility like Encore would spend billions of dollars up front building new power lines and substations, but they were not legally allowed to charge customers for that new infrastructure until a massive, highly political, multi-year rate case was fully resolved.
So they just sit there waiting to get paid.
Exactly. During that 3 to 5 year waiting period, inflation aggressively eats away at their returns. They're essentially floating billions of dollars of free infrastructure to the state.
Wow.
But the UTM fundamentally destroys that waiting period. If we connect this to the bigger picture, it changes their entire cash flow velocity.
I want to make sure I understand the mechanics of this perfectly. Because of this new UTM mechanism, Encore can now file this paperwork every 365 days.
Yes. They file it annually, bypassing the traditional multi-year delay entirely. They submitted the current UTM on April 22nd. The procedural schedule calls for testimony in July, a potential regulatory hearing on August 20th, and a final order with new rates going into effect in the second half of 2026.
That is incredibly fast for a government process.
It is. And in the absolute worst-case scenario, if the commission drags its feet and they don't have a final order, the mechanism allows Encore to implement interim rates around October 4th. This ensures their actual realized return on equity consistently stays as close as mathematically possible to that authorized 9.75%.
That is an amazing analogy I heard someone use. It is like an employee securing a contract that guarantees an automatic annual performance raise based on the exact projects they completed over the last 12 months. Before the UTM, utility companies were basically forced to wait 5 years for a highly combative formal promotion review just to get the money they had already earned, all while the broader cost of living went up. Now, Sempra gets paid almost in real time for the tangible value they are adding to the Texas grid.
Securing that real-time capital recovery is not just a nice financial bonus. I mean, it is absolutely critical for their survival right now. The amount of capital they are required to deploy in Texas over the next 5 years is historically unprecedented.
Which we will dive into with the massive AI infrastructure boom in a moment, but it is important to first analyze their other major operating region, which is California. Let's shift to Sempra, California, which encompasses SDG&E, San Diego Gas, and Electric and SoCalGas. They posted a strong quarter as well. Earnings increased by $44 million, which management primarily attributed to a higher base operating margin approved by the CPUC, the California Public Utilities Commission.
And they're also pushing for regulatory enhancements at the federal level, too. SDG&E filed an uncontested settlement in its TO6 proceeding with FERC, the Federal Energy Regulatory Commission.
Okay, let's clarify the jurisdictions there.
Right, so the CPUC handles local, state-level distribution rates, while FERC handles interstate and high-voltage wholesale transmission rates. If FERC approves this TO6 settlement, which management fully expects in the second half of the year, it will increase SDG&E's authorized base ROE to 10.28%, and establish a 54% equity structure.
That is even higher than Texas.
It is. And crucially, the terms of that settlement would be retroactive to June 1st, 2025.
Securing a 10.28% return on a 54% equity layer is a massive win. But honestly, whenever I look at California utilities, I cannot get past the absolute elephant in the room. Wildfire liability.
Right, the inverse condemnation issue.
Exactly. The legal doctrine of inverse condemnation has been a dark cloud over every utility operating in that state. Under inverse condemnation, if a utility's equipment sparks a fire, they are held strictly liable for all the damages, even if the utility did everything perfectly by the book, followed every safety regulation, and cleared every tree. It is essentially... But on this call, Sempra highlighted significant legislative momentum regarding a bill known as SB 254.
The progression of SB 254 is a critical development for anyone allocating capital to Sempra. The California Earthquake Authority, or CEA, recently published a comprehensive natural catastrophe report. Sempra's management team was highly encouraged by the findings, specifically because the report forcefully advocates for a whole-of-society approach to managing the wildfire crisis.
A whole-of-society approach? I mean, that sounds like political phrasing to say, stop bankrupting the power company for a statewide climate issue.
That's pretty much exactly what it means. It is a profound shift in the legal and political narrative. Caroline Guillen, a Sempra executive vice president, specifically outlined the company's 3 legislative priorities based on the CEA report.
And what are those?
First, they want to ensure wildfire victims are prioritized and compensated fairly. Second, they're pushing to implement a coordinated statewide approach to risk mitigation rather than localized piecemeal efforts. And third, they are demanding meaningful legislative progress within the current session.
They want action now.
Exactly. The fundamental breakthrough here is the state's sudden, explicit acknowledgement that the current legal framework is simply not durable. If the state forces utilities to absorb infinite liability, the utilities will eventually pass those infinite costs on to the ratepayers, which threatens the basic affordability of living in California.
And affordability is the ultimate political pressure point. Sempra's CEO, Jeff Martin, leaned into this heavily. He noted that the California governor's office is currently hyper-focused on the general livability of the state, specifically housing affordability, and the ongoing collapse of the property insurance market.
Right.
Sempra is brilliantly framing wildfire liability reform not as a corporate bailout, but as an essential emergency intervention to prevent residential insurance premiums and monthly energy bills from spiraling completely out of control for the average voter.
And beyond the legal maneuvering, Sempra is utilizing physical infrastructure to prove their direct economic value to those voters. Management highlighted a really compelling operational metric from January's winter storm, Fern.
Oh, the gas storage win.
Yes. During that severe weather event, SoCalGas was able to leverage its massive natural gas storage facilities. Because they had the physical capacity to store gas underground, they could withdraw inventory that had been purchased months earlier at significantly lower prices, rather than buying gas on the spot market during the absolute peak of the storm.
And what was the financial impact of that?
That single operational maneuver allowed their customers to avoid approximately $120 million in localized energy cost spikes.
I love that data point. Saving $120 million for your customers purely by having the foresight and the physical caverns to store natural gas underground, it completely validates the necessity of heavy physical infrastructure. But securing higher federal rates, navigating state-level liabilities, and optimizing gas storage is really just defensive blocking and tackling. It secures the present.
Right, it's maintaining the status quo.
When you listen to the management team on this call, they are clearly making a massive, aggressive pivot to secure explosive growth through the end of the decade. Here's where it gets really interesting.
The discussion of future guidance on this call was unlike any standard utility update I've heard in years.
This is where the numbers transition from impressive to borderline unbelievable. We are moving from present-day earnings into the future by examining the unprecedented infrastructure arms race currently happening on the Texas grid.
An arms race is not a hyperbolic media term. Jeff Martin deliberately used that exact phrase on the earnings call. He described the current macroeconomic landscape across the United States as a literal arms race to build out artificial intelligence infrastructure. And he explicitly identified the state of Texas as ground zero for this conflict.
The Q data from ERCOT, which is the Electric Reliability Council of Texas, the agency that operates the state grid, is staggering. Right now, ERCOT has 289 gigawatts of large load sitting in the interconnection queue, just waiting for approval to plug into the grid.
To contextualize what a gigawatt is, because it's a massive number, a single gigawatt provides enough power for roughly 750,000 average homes.
Okay, wow.
So to put ERCOT's 289 gigawatt queue into perspective, the entire installed generation capacity of the Texas grid today is only around 164 gigawatts.
Wait, really? The whole state right now is at 164?
Yes. Furthermore, the absolute highest peak demand the Texas grid has ever experienced in its history during the hottest summer day imaginable is roughly 85.5 gigawatts.
The math on that is terrifying. The waiting list for new power is more than 3 times the maximum amount of power the entire state has ever consumed at one single moment.
It's hard to even picture.
And here's the data point that defines the next decade of the market. Of that 289 gigawatts waiting in the queue, a massive 271 gigawatts is strictly data center related. It is AI training clusters, it is hyperscale server farms, it is the massive physical, concrete, and copper manifestation of the digital cloud. And to balance that out, ERCOT simultaneously has 450 gigawatts of new power generation in the queue, desperately trying to connect to the grid to sell electricity to those exact data centers.
We are looking at a logistical and engineering bottleneck of historic proportions. You have 450 gigawatts of new supply wind, solar, natural gas plants trying to physically reach 271 gigawatts of new hyperdense digital demand.
And they can't just magically beam that power over.
Exactly. The only thing that can bridge the physical distance between a wind farm in West Texas and a hyperscale AI data center in Dallas is high voltage transmission lines. The exact product that Sempra's Encore business builds. AI data centers are fundamentally different from traditional commercial buildings.
How so?
They house tens of thousands of specialized GPUs running at maximum utilization 24 hours a day. The thermal dynamics are so extreme they require liquid cooling systems, which in turn require even more power to run the pumps and chillers. They demand power densities that traditional urban grids were simply never engineered to handle.
Which perfectly explains Sempra's jaw-dropping capital expenditure plan. They have laid out a record $65 billion base capital plan. That level of spending is designed to grow their active rate base by roughly 11% annually every single year through 2030. But, and this is the single most critical piece of nuance from the entire earnings call, that $65 billion base plan does not depend on a single AI data center actually being built.
This is the asymmetric setup that should catch every investor's attention. Sempra's CEO was exceptionally clear on this point. If you look across the sector, other utility companies are struggling with regional transmission organizations. They are threatening to leave certain markets because the grid planning process has become entirely chaotic due to data center hype.
It's just a gold rush right now.
It is. But Sempra is different. Their massive $65 billion base plan is engineered entirely around the organic economic activity, traditional commercial growth, and baseline population expansion of Texas. The financial models are rock solid. They assume absolutely none of this 271 gigawatt AI data center load comes to fruition.
I want to make sure the listener grasps the magnitude of that. If the entire artificial intelligence bubble bursts tomorrow, if the tech giants cancel their server orders and the hyperscale data centers never pour a single yard of concrete, Sempra still executes a guaranteed $65 billion infrastructure plan based purely on people moving to Texas and turning on their air conditioners. But if those tech companies actually build the data centers,
then Sempra activates what management referred to as the incremental to the incremental upside.
Gotta love that phrasing.
Sempra's internal estimates suggest that the looming data center demand represents an additional $9 billion to $10 billion of incremental upside to their already massive capital spending plan.
That's wild.
To firm up the specific numbers, they are currently tracking ERCOT's 2026 Regional Transmission Plan, as well as an initiative known as the Batch Zero process.
What exactly is the Batch Zero process from an engineering standpoint?
Batch Zero is a localized, fast-tracked transmission planning initiative utilized by ERCOT to specifically address hyperdense load growth that cannot wait for the standard multi-year grid studies. It is essentially an emergency lane for critical infrastructure.
Like a fast pass for power lines.
Exactly. Just a couple of weeks prior to the earnings call, ERCOT released roughly 4 gigawatts of Batch Zero projects specifically targeted at South Dallas, carrying an estimated construction cost of $2.9 billion. The vast majority of that geographical footprint falls directly into Encore's exclusive service territory. That $2.9 billion is the first tangible wave of that $10 billion incremental bucket.
Seeing these numbers, Sempra's management is executing a massive strategic pivot. They are actively simplifying their entire corporate structure to become what they define as a pure-play utility. They realize the highest possible return on investment is funneling every available dollar into these guaranteed return high-voltage power lines inside the United States. To generate that capital, they are ruthlessly selling off non-core assets. Management confirmed the sale of their Ecogas assets in Mexico is on track to close in the second or third quarter of this year. They are also offloading an EV and VT-ITES contract, which encompasses non-core electric vehicle fleet infrastructure and transport telematics systems, through a transaction with KKR known as the SI Partners deal, which is also expected to close in Q2 or Q3.
The strategic philosophy behind these asset sales is capital recycling. They are systematically extracting equity out of international markets or complex tangential technology ventures, and they are pouring that recycled capital directly into the physical dirt of the Texas grid. The long-term projection is stark. They anticipate that by the end of the decade, nearly 60% of Sempra's entire corporate rate base will be located purely within the state of Texas.
I follow the logic of capital recycling, but I want to stop and look critically at one specific area of their portfolio. We received an update on their liquefied natural gas, or LNG, business during this call. They noted that at the ECA LNG Phase 1 facility, they successfully introduced feed gas and expect to reach commercial operations very soon. They also stated that Port Arthur Phase 1 and Phase 2 remain on time and on budget. But despite these operational successes, management explicitly stated they are intentionally reducing their overall capital allocation to the LNG space moving forward.
Yes, that was a major point.
If I look at the global geopolitical landscape, the global energy market is incredibly stressed right now. Europe is desperate for non-Russian gas. U.S. LNG is highly competitive on the global stage. If the world is screaming for natural gas, why on earth is Sempra intentionally walking away from the LNG space just to focus on stringing power lines in Texas? Isn't LNG an absolute cash cow?
You are identifying the core risk-reward dilemma that a utility management team has to resolve. Your assessment of the LNG market is entirely accurate. Jeff Martin pointed out on the call that the United States possesses incredibly deep capital markets, massive natural gas reserves in the Permian Basin, relatively low domestic price volatility, and the security of the rule of law.
Right.
All of those factors make U.S. LNG extremely attractive to sovereign buyers in Europe and Asia who are desperately trying to strip geopolitical risk out of their energy supply chains.
So if the demand is that ravenous and the U.S. advantage is that strong, pivoting away seems like leaving billions of dollars on the table.
The pivot makes sense when you evaluate the specific type of risk Sempra's shareholders are paying them to take. While an LNG export terminal is potentially very lucrative, it carries inherently massive geopolitical, commodity, and execution risks. The physical process of liquefaction requires chilling natural gas to negative 260 degrees Fahrenheit, loading it onto specialized maritime vessels, and navigating global shipping lanes.
It's not simple.
Not at all. You're exposing your balance sheet to volatile global commodity prices, complex international offtake agreements, massive multi-billion-dollar coastal construction delays, and the constantly shifting winds of federal export policies and tariffs. Now, contrast that entire geopolitical headache with building a regulated utility substation in Texas.
Right, the Texas dirt.
Exactly. In Texas, you build a physical power pole in the dirt. The state government immediately guarantees you a 9.75% return on the equity you put into that pole, backed by the legal mechanism of the ETM filing to assure you get paid within 365 days.
So it is the fundamental difference between operating in a volatile, free market global commodity space versus operating a state-sanctioned, highly regulated monopoly.
Sempra is deliberately choosing the low-risk, high-visibility path. They are choosing to construct the toll roads, the high-voltage superhighways, necessary to connect 450 gigawatts of power generation to 271 gigawatts of AI data center demand. It insulates the company from global market shocks and provides their investors with a vastly more sustainable, predictable, and compounding net profit.
When you lay it out like that, it makes total sense. Why gamble billions on whether European natural gas prices crash next winter when you can secure a legally guaranteed 9.75% return from the state of Texas to build the critical infrastructure that powers the entire artificial intelligence revolution?
Exactly. Furthermore, that highly focused strategic choice enables an incredible operational moat that Sempra is currently building against its competitors. When a company possesses a $65 billion state-guaranteed capital expenditure plan, they achieve economies of scale that allow them to execute maneuvers their smaller competitors simply cannot afford.
Such as entirely locking down the physical supply chain for the next 5 years.
Exactly that. During the Q&A portion of the call, Alan Nye, the CEO of Encore, provided a deeply detailed account of how they have been rigorously overhauling their supply chain diversification ever since the bottlenecks of the COVID era. Because they possess such massive, transparent visibility into their future project pipeline, they have been able to contractually secure their manufacturing slots and their union labor contracts all the way through 2028 for their entire base plan.
The specifics of that supply chain dominance are incredible. They literally stated on the call that they have every single physical component they need for the first 3 years of their plan legally locked in. For the final 2 years of that 5-year base plan, they have clear lines of sight and unwritten agreements already in place with manufacturers. We are talking about securing massive, highly specialized 765 kilovolt equipment, transformers that require globally constrained grain-oriented electrical steel.
It's brilliant supply chain management.
They are buying the factory capacity years before the equipment is even built. On top of the physical materials, they have nearly tripled their specialized contract labor force over the last few years.
And that labor constraint is arguably the most critical bottleneck in the entire infrastructure space right now. The industry is facing a severe shortage of skilled, high-voltage line workers. In that constrained environment, Encore becomes an incredibly attractive destination for specialized labor.
Why is that?
Well, if you manage a large contracting firm with thousands of skilled workers, you have a choice. Do you want to jump from state to state, chasing small, uncertain projects with utilities that might get tied up in multi-year regulatory hearings? Or do you want to sign a master service agreement with Encore, knowing you have guaranteed localized work in the state of Texas for the next 5 to 10 years?
It creates a massive gravity well. Sempra is pulling all of the vital manufacturing capacity, the raw materials, and the specialized human talent into their direct orbit purely because they wield the biggest, most reliable, government-backed checkbook in the region. So let's pull all of these threads together. So what does this all mean?
It means we have a lot to synthesize.
We have analyzed the headline earnings beat and the mechanics of GAAP versus adjusted accounting. We have dug deep into the regulatory victories, specifically the Texas base rate review, the 9.75% ROE, and the inflation-busting power of the 365-day UPM filing. We have looked at the mitigation of California wildfire liability through the whole of society approach. We have stared at the staggering physics of 271 gigawatts of AI data center demand knocking on the ERCOT grid's door. Now, we have to synthesize this mountain of data into an actionable, concrete conclusion for the retail investor listening right now.
Right, synthesizing the transcript and the underlying grid data paints a very definitive picture of where this company is positioned.
I'm going to take a firm, opinionated stance based on the data we just walked through. This was an exceptionally strong quarter and a highly bullish signal for Sempra stock. The results showcase not just a standard temporary earnings beat, but a massive, structural, multi-decade de-risking of the company's entire future cash flow.
I agree, and the supply chain execution data heavily reinforces that bullish thesis. When a management team has already contractually secured the scarce physical materials and the specialized human labor required to execute a multi-billion-dollar infrastructure plan in a highly inflationary environment, they have constructed a formidable, almost impenetrable moat against execution risk. They are insulated from the supply shocks that will inevitably delay their competitors.
For you, the listener, whether you are currently holding Sempra or considering adding it to your portfolio, this stock represents an incredibly insulated backdoor play on the artificial intelligence boom. Look at the asymmetric risk profile they have engineered.
It's very
If the hype around these 271 gigawatts of data centers completely fizzles out, if the AI revolution stalls, the capital dries up, and those massive hyperscale servers never get plugged into the Texas grid. Sempra's $65 billion base capital plan remains completely rock solid. It is fully funded and justified by organic baseline Texas population growth. Under that worst-case scenario, they still grow their earnings at a highly reliable 7% to 9% annually.
Conversely, if even a fraction of those proposed AI data centers actually break ground and require power, Sempra holds an additional $10 billion in incremental, highly profitable upside that is not currently baked into their baseline assumptions. It is an asymmetric risk profile that heavily favors the investor.
Absolutely.
The downside is structurally protected by guaranteed state regulation and the UTM mechanism, while the upside is directly tethered to the largest, most power-hungry technological arms race of our generation.
It is the ultimate infrastructural setup. They hold a government-sanctioned monopoly to build the tracks, and they get paid a guaranteed yield regardless of how many bullet trains actually arrive at the station.
And that dynamic really forces you to evaluate your own portfolio construction. What stands out to you as an investor? Are you more compelled by the safety, the predictability, and the inflation protection of their guaranteed base rate increases in Texas? Or are you drawn to the stock because of the massive, almost unfathomable upside potential of the ECOQ and the AI infrastructure boom? That is the multi-billion-dollar question every portfolio manager has to answer. As we wrap up this deep dive into Sempra's Q1 2026 earnings, I want to leave you with a final provocative thought to consider. We started this analysis by talking about the shock of finding high-speed bullet trains in your quiet backyard. But when you look at the raw physical constraints of the digital economy, if 60% of Sempra's entire corporate rate base is going to be located in Texas by 2030, and 271 gigawatts of hyperdense data center load are actively knocking on ERCOT store today begging for electricity, are we looking at a future where holding a traditional, quote-unquote, boring heavy metal utility stock like Sempra is actually the most reliable, de-risked, and lucrative technology play available on the entire stock market? It definitely demands a complete reevaluation of what constitutes a technology stock in an era defined by extreme physical infrastructure bottlenecks. The digital cloud does not exist in the ether. It exists in physical buildings that require massive amounts of thermal cooling and high voltage power.
The digital revolution has a very real physical speed limit, and Sempra owns the asphalt. Thank you for joining us as we unpack the engineering and the financials today. Keep digging into the data, keep questioning the consensus, and we will see you on the next deep dive.